Due to Israel and rising tensions with Iran, global stock markets were dragged down. All took a hit. Let's take a look at how badly markets fell. Bank of America just released new data. It shows that just last week, U.S. equity funds saw $9.8 billion in outflows, nearly $10 billion. This figure is the highest in 11 weeks, which shows investors are clearly rattled. There's fear in the air, and it's not just the U.S. stocks. Even well-performing European funds this year took a hit. For the first time in 9 weeks, they saw net outflows. How much flowed out? $600 million. What does this mean? It means global investors are pulling out. It's a clear exit signal. Funds are flowing out. That means they've lost confidence in the market. So they're selling and moving out, right? You can clearly feel it. They're exiting. People aren't willing to take risks now. At this point in time, the risk outweighs the return, so they pull out. On Friday, all major European indexes fell. France, Germany, Spain, and Italy all dropped more than 1%. U.S. markets were hit hard, especially bad this time. The Dow Jones plunged. By how much? Over 700 points. That's a drop of 1.79%. This decline had a major market impact. The Dow's fall shook investor sentiment, and not just the Dow. The S&P 500 and Nasdaq too both saw notable pullbacks. How big were the drops? They both fell more than 1%, over 1%, especially critical now at key resistance. The Nasdaq and the S&P 500 were near previous highs, just a little more strength, and they could have broken out. A breakout to new highs was close. Record highs even, but at such a crucial moment right at the top, external factors hit the market. Tensions between Israel and Iran in the Middle East led the market to do what? To clearly shift toward risk-off mode. Stimulated by global uncertainty, the market ended Friday with one of its biggest recent drops. Actually, this pullback isn't necessarily a bad thing. Why? On the daily chart, the S&P 500 shows clear MACD flattening. The MACD has started. That means the index kept rising, but MACD didn't make new highs, which indicates momentum is running low at this stage. So instead, a brief pullback here might help. A reset. Not a bad thing. If it holds at the current support level, we can see from smaller time frames that MACD showed divergence earlier, so this dip can correct that. Technically, it's a good reset. It helps resolve prior divergence. Right now, upside momentum is weak. Why is momentum weak? Because funds are hesitant to chase the rally. They're unsure. So if the market pulls back a bit, it could attract sidelined buyers. Those looking for a second entry, it offers a better entry point, and it helps clear the divergence. So for the index, this correction might not be a bad thing. It could create new opportunities. So what do we see? This short-term dip hasn't changed the overall trend. The uptrend remains intact. No clear signs of a top yet. There's just some resistance above. That upper level is where pressure lies. The prior high is a key resistance zone. The market overall still holds a strong upward bias. Many are hoping that the S&P 500 or Nasdaq can hit new all-time highs. This bullish sentiment is still shared by many investors. So a pullback now isn't necessarily bad. Even though the market today is facing quite a bit of pressure, the headwinds are real, from both news flow and technicals. Geopolitical uncertainty in the Middle East, unclear U.S. economic outlook, and uncertainty around the Fed policy, whether more rate hikes are coming or not. Right now, the market index is under pressure from all these. It's feeling pretty weighted down. Investors can really sense the stress. They're worried about making the wrong move. One misstep and they might get burned. So for regular investors, now is a time to stay cautious. Market sentiment can shift too quickly. Up today, down tomorrow. That could be the short-term trend. Looking at the S&P 500, it's clearly pulling back after a rally. What's likely next? Probably some consolidation in this zone. After this adjustment, the pullback may not be deep. It could just drift sideways near the top. That's a more likely scenario, so once this correction ends, we will likely see another upward push. It may offer new opportunities because the market still leans bullish. That mindset continues to shape sentiment. It's still in play. This bullish mentality hasn't fully faded yet, so the market still has bullish sentiment supporting it. It's just that now uncertainties are piling up again, especially in the Middle East. And historically speaking, geopolitical tensions often trigger short-term panic selling in the market. So that's what happened last Friday. Markets clearly showed signs of panic. Under panic-driven sentiment, pullbacks are often sharper, but once it stabilizes, the next rally tends to be stronger, more resilient, and solid. So based on historical patterns, geopolitical shocks usually bring short-term dips, quick sharp declines due to panic. But those pullbacks often come with opportunity. The key is patience. Wait for the right timing. Today's market is like walking a tightrope, and a slight disturbance can trigger sharp volatility. So what should investors do? Stay calm. Don't let emotions drive decisions. Make rational choices based on your risk tolerance. If you're holding stocks, there's no need to panic. Ups and downs are part of the market cycle. A short-term pullback is normal. This dip might actually help build momentum for the next rally. It could be setting up the next move higher. That's the interesting part right now. What do I mean? Take the tech giants for example. Among the big 7 tech names, most of them actually declined, but Tesla rose nearly 2%. It was a surprising move by Tesla. Given the current environment, Tesla has been relatively weak. It's still considered a laggard. Compared to others, it's weaker. For example, Microsoft hit all-time highs, and so did Nvidia. By comparison, Tesla's fundamentals are not as strong, but last Friday Tesla was the only one that went up. Did you notice something interesting here? Among the Tech 7, only Tesla was up. The rest all closed lower. Some dropped 1%, some fell 2%. NIO dropped 2%, only Tesla gained nearly 2%. So people are asking, in this kind of market, why did Tesla rise? Is it starting to outperform now? It should have pulled back with the broader sell-off, but it didn't. Instead, it rose against the trend. Does that mean Tesla's getting strong again? Not necessarily. It was likely driven by positive news. What news? Trump ordered the White House to overturn California's EV mandate. In the short term, it's a sentiment boost for Tesla's stock price. But technically speaking, Tesla is still at a key resistance level. We need to stay cautious. There's clear sell pressure in this range. What's above? A visible head and shoulders pattern. It hasn't broken out of that pattern yet. Still no confirmed breakout. Until we get that confirmation, we shouldn't chase opportunities here. Tesla's current price still faces many uncertainties. What kind of uncertainty? Several key areas. First, changes in subsidy policies. The U.S. tax credit removing the $7,500 benefit for buyers could hurt Tesla's competitiveness, especially for higher-priced Model 3 and Model Y. Subsidy cuts in Europe also add sales pressure. Those reductions are weighing on Tesla's performance. And there's another factor, trade policy risk. Policy uncertainty. Specifically, Tesla faces uncertainty in tariff policy. Changes in global trade policy could impact Tesla's supply chain and cost structure, ultimately affecting its profitability. There's also regulatory uncertainty. Tesla's robotaxi project is one of the market's most anticipated growth areas. Investors have high hopes for its potential. It's a crucial initiative. However, securing regulatory approval for operations is extremely complex. Issues around data security and compliance raise policy risks. That adds to Tesla's regulatory uncertainty. Also worth noting is retail versus institutional behavior. The tug of war between them affects Tesla stock. This is a bit nuanced, but institutional investors clearly move the market more. That's true across any market. Institutions act as trendsetters and price drivers. They shape overall market direction, so their influence on stock price is substantial. Naturally, Tesla is also affected by this dynamic. For example, several Wall Street firms recently downgraded their Tesla ratings. One example is Baird, a well-known research firm. They downgraded Tesla from outperform to neutral. That reflects caution on Tesla's near-term outlook. So what does this downgrade signal? It shows that institutional concerns around Teslas are rising. This downgrade sends a clear message. What message is that? That institutions see short-term risks in Tesla. They are concerned. That includes overhyped expectations on the robotaxi project, growing competition, and Musk's policy-related risk exposure. Rating changes can impact market confidence. They can trigger investor sentiment swings and weigh on the stock price. Although institutions are cautious on Tesla's near-term outlook, they're not all bearish. Some still believe Tesla's long-term strength remains. Its EV technology and factory network are seen as lasting competitive advantages. Its gigafactory footprint is part of its long-term edge. These factors form the core of Tesla's competitiveness. They will help support its stock in the long run and attract long-term interest. But in the short term, if we look at the chart, it's still volatile. Uncertainty in the stock is still very high. So don't let Friday's move mislead you. It doesn't mean the uptrend has started. We still need to wait. Fundamentally, challenges remain. Uncertainty is still high. Even with strong future outlooks, the near-term risk can't be ignored. Confidence is there, but price action may stay choppy. Short-term uncertainty is still high. Expect larger fluctuations, fewer clear opportunities. So to trade Tesla, what should we wait for? Wait until it breaks above this zone and clears previous resistance. Only then will it be a valid setup. That's when opportunity starts. So in the short term, if you're looking to trade Tesla, you should remain cautious. Some investors saw the earlier panic sell-off and jumped in to buy the dip. Some of them may have gotten it right. Now they're feeling confident, but this kind of trading definitely carries some gambling traits. Of course, we're not saying Tesla has no future potential. There are still opportunities. Looking ahead, Tesla has strong long-term prospects. It's just that short-term setups carry a lot of uncertainty. Alright, so this was a brief analysis of the share market. If you have any other thoughts or questions, feel free to leave a comment below. Let's discuss together.